Imagine you make a smart move. You realize a stock you own is down $5,000. You decide to sell it, take the loss, and use that loss to lower your tax bill for the year. It is a textbook maneuver. You feel like a genius. A few weeks later, you see the price of that stock starting to tick back up. You think, great, I have harvested my loss. Now I will jump back in for the ride up. You click buy. And just like that, you have triggered a silent alarm at the IRS. You didn't just buy a stock, you triggered a wash sale. And that $5,000 deduction you were counting on, it just vanished. It is disallowed. Gone. And the worst part is, you might have made this mistake inside your IRA, which means that money is not just deferred, it is incinerated. Today we are walking through the minefield of the wash sale rule. This is one of those rules that sounds like obscure accounting trivia until it costs you 4 figures on your tax return. The wash sale rule is designed to stop you from having your cake and eating it too. The IRS does not want you to claim a tax loss if you didn't really exit the position. If you sell low and buy it right back, they say that is a wash. No harm, no foul, but also no tax break. The problem is that the definition of buying it right back is much wider and stickier than most people realize. It involves your spouse, your retirement accounts, and a 61-day calendar that is very easy to misread. I'm going to break down exactly how to visualize this timeline so you never accidentally trip the wire. If you want to keep more of your own money instead of sending it to the Treasury, go ahead and subscribe. It is the best return on investment you will get on your time today. Now, let's look at the calendar. There is a persistent myth that the wash sale rule is just about what you do after you sell. You sell a stock on Monday, so you tell yourself you just have to wait 31 days to buy it back. That is only half the story. The rule is actually a form of time travel. The IRS looks forward in time, but they also look backward. The rule states that a wash sale occurs if you buy a substantially identical security within 30 days before or 30 days after the sale. It is a symmetrical window. Many investors get caught because they bought a few shares 2 weeks before they decided to sell the whole lot at a loss. That previous purchase, the one you made when you were still feeling optimistic, comes back to haunt you. It taints the sale you are making today. You have to stop thinking about a 30-day waiting period and start thinking about a blast radius. Let's put some hard numbers on this so you can visualize the danger zone. You have the day of the sale. That is day 0. Then you have the 30 days prior to that date. And you have the 30 days following that date. That is 30 plus 30 plus 1. That equals 61 days. If you trade frequently, or if you are dollar cost averaging into a falling market, you are almost certainly operating inside this 61-day window constantly. If you buy shares on day minus 15 and then sell everything on day 0 at a loss, that purchase on day minus 15 triggers the wash sale rule for those specific shares. You cannot deduct the loss on the shares you just bought and immediately sold. The math is binary. Did a purchase occur in the window? Yes or no? If yes, the deduction is disallowed. The IRS computers are very good at matching these trade dates. They do not care about your intent. They only care about the calendar. Why do we fail this test so often? It usually comes down to panic and regret. The market is volatile. You see a position down 20%. You panic and sell to harvest the loss and stop the bleeding. But 3 days later, the market rallies. Suddenly, the fear of loss is replaced by the fear of missing out. You panic buy the shares back because you don't want to miss the recovery. That emotional whipsaw is exactly what the rule is designed to penalize. You are trying to have the tax benefit of a bear and the upside potential of a bull simultaneously. The other psychological trap is automation. We are told to automate our finances, set up automatic investments. But if you have an automatic buy order hitting your account on the 15th of the month, and you sell for a loss on the 20th, your robot just walked you right into a wash sale. The convenience of automation works against the precision required for tax planning. Here is the protocol for handling the timeline. Before you execute a sale for tax loss harvesting, you need to look at your transaction history for the last 30 days. Did you buy any shares of this specific ticker? If yes, you need to wait. You need to let those shares age past the 30-day mark if you want to claim the full loss on them. Once you execute the sale, you need to mark your calendar for day 31. Not day 30, day 31. During that waiting period, you literally cannot touch that ticker. You have to sit on your hands. If the market rips higher without you, that is the price you pay for the tax deduction. If you cannot handle the risk of being out of the market, you need a different strategy, which we will get to in a minute. But for the timeline, the rule is strict. 30 days back, 30 days forward. No touching. You might be thinking, okay, Tom, I can read a calendar. I will just sell Coke and buy Pepsi. Or I will sell an S&P 500 fund and buy a different S&P 500 fund. That seems safe, right? Well, this is where the IRS gets vague on purpose. They use a phrase that has terrified accountants for decades: substantially identical. If you get this definition wrong, you don't just lose the deduction, you might not even know you lost it until you get audited. Let's talk about what identical actually means. The phrase substantially identical is the trapdoor. The IRS does not provide a master list of which stocks are identical to which. They leave it up to facts and circumstances. However, we know the obvious ones. If you sell Class A shares of a company and buy Class B shares of the same company, that is substantially identical. If you sell a stock and buy a call option on that stock, that is substantially identical. You cannot use derivatives to hide your exposure. But where it gets tricky is with funds and ETFs. If you sell the Vanguard S&P 500 ETF and buy the iShares S&P 500 ETF, are they substantially identical? They track the exact same index. They hold the exact same stocks in the exact same proportions. Most conservative tax professionals will tell you, yes, that is a wash sale. You are buying the same engine with a different paint job. So, how do you stay in the market without triggering the rule? You have to change the engine, not just the paint. You need to swap into something that is correlated but not identical. This is the cousin fund strategy. If you sell an S&P 500 ETF, you cannot buy another S&P 500 ETF. But you could buy a total stock market ETF. A total market fund includes small caps and mid caps that aren't in the S&P 500. The performance is usually very similar. We are talking a 99% correlation in many years. But the underlying basket of goods is legally different. One has 500 stocks, the other has 3,000. That difference is usually enough to pass the substantially identical test. You are staying invested in US equities, so you don't miss a market rally, but you have technically changed your investment vehicle. The psychological hurdle here is what we call tracking error. You worry that in the 30 days you are holding the cousin fund, the original fund will outperform it. You worry that the S&P 500 will go up 5%, while the total market only goes up 4.8%. That is a valid concern, but you have to weigh that small potential difference against the guaranteed value of the tax loss harvest. If you are harvesting a $3,000 loss, that could be worth $1,000 in your pocket, depending on your tax bracket. Is a 0.2% tracking error worth worrying about when you are locking in $1,000 of hard tax savings? Usually, the answer is no. But our brains obsess over the perfect optimization. We want the tax break and the perfect index tracking. You have to let go of perfection to get the deduction. Here is the protocol for the swap. Before you sell your loser, identify the partner fund. If you are selling a tech ETF, look for a broader growth ETF. If you are selling a specific international country fund, swap into a broad emerging markets fund. Have the ticker ready. Execute the sale of the loser and the purchase of the replacement immediately, back to back. Do not wait. This minimizes your time out of the market. Then, set a reminder for 31 days later. After that window closes, if you really prefer the original fund, you can switch back. You can sell the cousin fund and buy the original one again. But honestly, most of the time, the cousin fund is fine and you can just keep it. Simplicity usually beats complexity here. Now, I know what some of you are thinking. Tom, I have a loophole. I will sell the stock in my account, and I will just have my wife buy it in her account. It makes sense. Different social security numbers, maybe even different last names. But the IRS is way ahead of you. They treat married couples as a single economic unit. If you try this trick, not only will you trigger a wash sale, but you create a paperwork nightmare that you will have to explain to your accountant. And it gets even messier if you involve your business. There is a belief that if you file your taxes separately, married filing separately, you are immune to this rule. The Supreme Court and the IRS generally disagree. While the tax code explicitly mentions the taxpayer, guidance and court cases have historically treated spousal transactions as indirect wash sales if the intent is to avoid the rule. In a normal joint account or when filing jointly, it is black and white. If you sell Apple at a loss and your spouse buys Apple the next day in their personal account, that is a wash sale. The loss is disallowed in your account. The shares your spouse bought now have an adjusted basis. You have essentially transferred the cost basis from your account to theirs. You didn't save any taxes. You just moved the problem from the left pocket to the right pocket. It goes beyond marriage. It applies to corporations you control. Let's say you are a day trader, or you have an LLC for your consulting business that has a brokerage account. You sell a stock personally to harvest a loss, and you have your LLC buy the stock. The IRS looks at that and says, "Nice try." Because you control the entity, the purchase is attributed to you. Section 1091 is designed to prevent you from maintaining your position while claiming a tax deduction. If you control the buyer, you haven't really broken your economic connection to the stock. This is a common area where people think they are being clever, but they are actually just auditing themselves. The IRS computers might not catch this one instantly, but if a human auditor looks at your transaction logs, it is an open and shut case. The psychological error here is compartmentalization. We tend to view our accounts as islands. My IRA is one island. My wife's brokerage is another island. My business account is a third. We think the laws of physics don't cross the water. But to the IRS, your entire financial life is one continent. They view your household's net worth as an interconnected web. When you try to game the system by hopping islands, you are usually just complicating your own life. The mental energy required to coordinate a secret buyback in a spouse's account is rarely worth the tax savings. You are introducing friction and potential legal gray areas to save a few $100. It is a bad trade on your peace of mind. The protocol for households is communication. If you are doing tax loss harvesting, you need to tell your spouse. You cannot operate in a vacuum. A simple text message, "Hey, I am selling Exxon today for a tax loss. Please do not buy Exxon in your account for the next month." If you have a financial advisor managing one account and you manage another, they need to talk to each other. This is a very common way wealthy people trigger wash sales. The left hand doesn't know what the right hand is doing. The safest approach is to treat all accounts under your roof as one big portfolio. If the house is selling, the house cannot be buying. Keep it simple. Everything we have talked about so far is annoying, but fixable. In a taxable account, a wash sale just defers your loss. You get it back later. But there is one scenario where the loss is not deferred. It is destroyed. It is gone forever. If you trigger a wash sale by repurchasing shares inside an IRA or a Roth IRA, you have entered the worst of all possible worlds. This is the mistake that you literally cannot afford to make. Here is why the IRA wash sale is lethal. Normally, when a wash sale happens in a taxable account, the disallowed loss is added to the cost basis of the new shares. If you lose $1 now, your new shares are worth $1 more on paper, so you will have less gain later. It washes out. But an IRA has no cost basis for tax purposes. You don't report gains and losses in an IRA, so there is nowhere to add that disallowed loss. The loss in your taxable account is disallowed, but the basis adjustment in the IRA is meaningless. Revenue Ruling 2008-5 clarified this. The loss essentially evaporates. You sold low in your taxable account, you bought back in your IRA, and the tax benefit you were chasing is deleted from existence. You still have the stock, but you have permanently forfeited the tax deduction. Let's run the numbers on how expensive this is. Say you sell a tech stock in your brokerage account and realize a $10,000 loss. At a high tax bracket, that loss could be worth $3,000 or $4,000 in tax savings. But you really like that stock, so you immediately buy it back inside your Roth IRA. Boom, wash sale. The $10,000 loss on your tax return is denied. You owe the IRS the taxes as if that loss never happened. And in your Roth IRA, the basis doesn't change. You essentially just donated $3,000 to the government for the privilege of moving your shares from one account to another. There is no recovery mechanism. There is no getting it back later. It is a pure, unforced error. Why do people do this? It comes down to asset allocation. You want to maintain a certain percentage of your wealth in US stocks. When you sell in your taxable account, you feel underweight in stocks. So you look at your IRA, which has some cash sitting there, and you think, I'll just top up my allocation over there. It feels like responsible portfolio management. You are rebalancing, but you are rebalancing blindly. The wall between your taxable self and your tax-advantaged self is transparent to you, but it is a brick wall to the IRS. You have to resist the urge to use your IRA as a hedge for your taxable moves. They need to operate on independent tracks, or at least on non-conflicting tracks. The protocol here is strict separation. Many advisors suggest holding completely different asset classes in different accounts to avoid this entirely. Maybe your taxable account holds ETFs for the S&P 500, and your IRA holds ETFs for dividend growth. If the tickers are different, you can trade freely without constantly cross-referencing. If you must own similar funds, ensure they are tracked by different indices. Use the cousin fund strategy we talked about earlier, but apply it across accounts. Never, ever buy the exact same ticker in an IRA that you trade in a taxable account. It is just asking for trouble. The risk of a permanent loss outweighs the convenience of consolidation. We have covered the big structural mistakes. But there is a tiny, annoying mistake that happens to almost everyone who uses dividend reinvestment. It's the robot uprising. You do everything right. You wait, you pick the right funds, and then a tiny $50 dividend payment comes in, gets automatically reinvested, and ruins a $50,000 tax strategy. Let's talk about DRIPs. Dividend reinvestment plans, or DRIPs, are great for building wealth, but they are terrible for tax loss harvesting. A DRIP automatically takes any cash dividend you receive and buys more shares of that stock. If that automatic purchase happens within 30 days of your tax loss sale, it triggers a wash sale. Now, it usually doesn't disqualify the whole loss, only the loss on the amount of shares you bought. But it creates a tax reporting mess. If you sold 1,000 shares and your DRIP bought 5 shares, you now have a wash sale on those 5 shares. Your 1099 form at the end of the year is going to have weird codes and adjustments. It complicates your life disproportionately to the size of the trade. Let's say you harvest a loss of $5,000. 2 weeks later, a quarterly dividend hits, and your account automatically buys $50 worth of stock. The IRS rules say you have acquired substantially identical securities. The wash sale rule triggers on that $50 purchase. The loss associated with that small chunk of shares is disallowed and added to the basis of the new $50 worth of stock. You still get to deduct the rest of the big loss, but now you have this lingering tax lot with a weird cost basis that you have to track forever. It is like getting a pebble in your shoe. It doesn't stop you from walking, but it is annoying every single step of the way. The issue here is the set and forget mindset. We love passive investing. We want to be hands-off. But tax loss harvesting is an active sport. It requires you to take the controls off autopilot. You have to switch from being a passive passenger to an active pilot for that 61-day window. People forget that passive doesn't mean unconscious. You have to be aware of the schedule of your dividends. If a fund pays out quarterly, you need to know when that date is. Harvesting a loss 3 days before a scheduled dividend distribution is just poor planning. You are setting yourself up for an administrative headache because you didn't check the calendar. The protocol is simple. Turn it off. Before you execute a tax loss harvest, go into your brokerage settings. Turn off reinvest dividends for that specific security. Set it to pay to cash. Also, check for any automatic monthly investments you have set up from your bank account. Pause them. Once you are past the 30-day window, or once you have safely swapped into a different fund, you can turn the automation back on. But for that danger zone window, cash is king. Let the dividends pile up in your settlement fund. It keeps your tax lots clean and your accountant happy. So, let's recap the battle plan. A wash sale isn't the end of the world in a taxable account, but it defeats the purpose of selling. To avoid it, you need to respect the 61-day window. 30 days before, day of sale, 30 days after. You need to avoid buying substantially identical securities, which means swapping Coke for Pepsi or an S&P 500 ETF for a total market ETF. You need to coordinate with your spouse so you aren't buying what they are selling. You need to essentially quarantine your IRA so you don't trigger a permanent loss. And finally, you need to turn off the robots. Disable those drips and auto buys temporarily. It sounds like a lot of rules, but it really just boils down to one principle. If you are claiming a loss, you have to actually exit the position. I'm curious to know, have any of you ever accidentally triggered the IRA wash sale, the one where the money disappears? It is painful to admit, but leave a comment if you have learned that lesson the hard way. It helps others see the reality of the risk. If you found this breakdown helpful, and you want to navigate the tax code without needing a law degree, make sure you are subscribed. We talk about money here in a way that actually respects your intelligence. Thanks for watching, and I will see you in the next one.